Well, good morning, everyone. I know that there are people that are still joining, but I think we should just go ahead and get started because we do have a lot of material to cover. Welcome to our quarterly market update webinar with some additional financial planning considerations for you to consider. We're glad you could make time out of your busy day to join us. My name is Greg Estes. I am the Chief Investment Officer for MBI. I will be joined by my teammate Stephanie Anderson, who's a manager of financial planning and wealth management services. MBI is a wealth manager. We offer comprehensive financial planning and investment management, which we are pleased to do for our clients. We are a part of Counselor Buchanan and Mitchell, which is a full-service accounting and advisory firm. So we offer a breadth of services for our clients. Just to kind of give you an overview of what we're going to cover today, we'll start with a kind of a lay of the land and the economic outlook, what's been going on, what might happen going forward. And then we'll slide into a market review, just to kind of see what's happening in capital markets, and there's some interesting developments there. That kind of leads into an asset class comparison. There's a lot of talk about the Magnificent Seven, but what about other parts of the equity market? What about fixed income? What about other commodities and currencies? So we want to touch on those different categories of possible areas for investment. And then we're going to move over to kind of a really a bigger topic, which is kind of the financial planning guide looking forward for 2026. There are a lot of questions out there. And hopefully, Stephanie can provide you some guidance, maybe some things that you need to ask yourself to better prepare yourself for going into 2026 and beyond. Okay, so I think I want to make a couple of points here. The first is that, as investors, we have to stay alert. Market volatility is it's not anything new, although I would say in our current situation, the current dynamic, we're seeing more of it and in quicker cycles than we've seen in the past. And whether that's with sudden announcement of tariffs like we saw recently related to Greenland, and announcing tariffs being put on European countries, to those tariffs then not being put on those countries, the cycle seems to be moving a lot faster. So you definitely have to stay alert. You also need to be resilient. And so you need to have a portfolio that's set up to be resilient. You need to have a financial plan that also emphasizes resilience because, things are changing. They change quickly. They change back. They just change frequently. So how is the economy doing? So over the last couple of quarters, it's been very, very strong. This chart is showing you quarterly growth in gross domestic product, which is really the measure of the economy in the U.S. You can see there was one down quarter at the beginning of 2025. That was the first quarter, and that was basically to be expected. That was mostly companies deferring purchasing as the concern over tariffs that were announced in April were taking place. So essentially what companies had done is they tried to purchase as much supplies and raw materials as they could before those tariffs, and then they delayed purchasing in the first quarter. But then the second and third quarters have shown very strong growth. As a matter of fact, the third quarter, which ended September 30th, but doesn't get reported until later into the back end of the year, showed growth of 4.3%. As a matter of fact, the most recent revision, which just came out today, showed that the third quarter grew by 4.4%. So pretty strong growth in the economy. Consumer spending is still very strong, and companies are investing in themselves. Q4, which is technically over but has not yet been reported, could see this continue and maybe even accelerate a bit. The Atlanta Fed has its own estimate called GDP Now, which is sort of a real-time estimate of what Q4 growth could be, is this green line, and it shows you something above 5%. That would be pretty strong economic growth. The blue range, by the way, it's a little bit of a lag. This is economists' estimates of what growth could be for Q4. Don't get too hung up on the fact that it's much lower than the Atlanta Fed's GDP Now estimate. I suspect that it's delayed in reporting, but you should see that consensus estimate kind of moving up to kind of match or mirror that GDP Now estimate. But the bottom line here is that Q4 could continue the strength we've seen in economic growth. However, there's always some sort of however. Generally, the labor market is getting softer. So the chart on the left is showing you average monthly jobs added in the economy by year. So you can see, 2020 was a year with a recession. There was, job changes were negative because everything shut down. And then coming out of COVID and with everything reopening, job growth was very high, to be expected, and then has been declining, so that 2025 had only about 50,000 jobs created on a monthly basis. That's pretty low. If you think about kind of what should be a normal average or healthy average, around 200,000 or maybe a little bit below that would be, pretty good. So it's clear that the job market is slowing, that hiring is slowing. The chart on the right is just showing you unemployment, which is, has been creeping up since kind of a multi-decade low in 2023. By the way, you can see a dashed line in this unemployment rate. That's the government shutdown, where a lot of this information wasn't being collected and certainly was not being published. So, the unemployment rate has moved up over the last few years. In terms of, if we were to look out over multiple decades, it's not at, any kind of a high or anything like that, but it has been trending up. So for those that are out of work, it is definitely harder to find a new job. It's kind of continuing on with the labor market. So the chart on the left is showing you change by industry in 2025. So what industries are growing? Health services, utilities, leisure, and hospitality. The one that's really declined has been the federal government. So that was no surprise with DOGE being kind of a headline grabber in 2025. I think in particular for those in the DC metro area, this is particularly pronounced for the job market. Typically, we don't see that kind of job decline in the federal government. So whether that can continue, I think, is kind of an open question. DOGE seems to have taken kind of a backseat to other attention for the administration. So it remains to be seen whether federal government jobs can continue that kind of a decline going forward into 2026. And then I just thought it was interesting to look at unemployment rates by age group. Naturally, younger people tend to have higher unemployment rates than older people. But you can see, how this is trending for younger people. It's generally been a trend up, particularly for teenagers. But again, this is sort of, it kind of ties into the fact that you may have heard the reference to a K-shaped economy, which is to say that those that are doing well are doing better, and those that are doing worse are doing worse. In this kind of an economy, it does kind of overlap with age as well. So if you're younger, it might be tougher in this economy than if you are older. Inflation has moderated over the past year. This chart is showing you kind of average hourly earnings in blue, and then the change in prices, which are in gray. And somewhat of a positive is that inflation has definitely declined from that real high point that we saw coming out of reopening from COVID. And it's been generally trending down with a little bit of noise, while average hourly earnings have trended, although they're trending down, are still above price changes. So that's generally a positive for workers to see their earnings growing at a faster rate than prices. Looking at inflation on a different scale, and this is showing you a couple of different measures of inflation. The yellow is the Consumer Price Index, and the red is the Personal Consumption Expenditures Index. So at any point going back to December 2020, you can see what the 12-month increase in prices was for that period of time. And what you can see is that those inflation rates have trended down from 2022. The blue line, by the way, that's the Fed's, essentially the Federal Reserve's response to inflation. They set the Fed funds rate, and when inflation is very high, they try to clamp it down by increasing the interest rate. So what you see is as inflation trended down, the Fed in 2024 cut rates a few times by a full percent in total, and then going into the fall of 2025, they cut rates again 3 times, feeling more comfortable that inflation was lower. But I've got it circled here, the most recent inflation numbers. A couple of things are important to note. One, you see that the red line hasn't really caught up with the yellow. Again, the government shutdown delayed some release of some of this information. And so CPI numbers have recently come out showing, about 3.6% on core inflation. That means excluding food and energy. So it is definitely lower, but there are still tariff concerns. Right now, tariff levels are all in all about 10.7%. Now, these numbers can fluctuate. They're also kind of hard to pinpoint because there's a lot of announcements and then changes and loopholes and things like that make it very difficult to estimate what that number is. This chart is showing you, by the way, by country, what those tariff rates look like. So you can see the huge spike in the tariff for goods coming out of China. But the effective tariff rate, which is in black at 10.7%, is much higher than where it had been several years ago, although I would say versus what we heard back in April of 2025 is not as high as some of those announced punitive tariffs that never really took shape. So they were announced and then negotiations were made, and then those rates with other countries were lower. So, and then, we just recently had the announcement on Europe with some tariffs that was taken away. We have a Supreme Court case that it could theoretically decide once and for all whether the administration has the power to implement these or announce and implement tariffs based on, they're citing kind of an Emergency Powers Act, whether they actually have the authority to do that. I suspect if the Supreme Court rules against the administration, there could be some short-term volatility because of confusion about how one returns the government receipts on all of those tariffs. But the bottom line is it would generally be good for global trade if those tariffs were unwound. Okay, so how has the stock market been doing over the last year and change? So this chart goes all the way back to the beginning of 2025. So we're looking at 4 different indexes and how they've been performing since the beginning of 2025. The purple line is the All Country World Index excluding the U.S., so everything outside the U.S. The blue line, the Russell 1000 index, is a measure of large cap stocks in the US. And then the red line is the S&P 400 mid cap index, so mid-sized stocks, and then green S&P 600 small cap index, small stocks. So you can see early on in 2025 a gap developing between things outside the U.S. and in the U.S. And a lot of that was basically speculation about tariffs. And then you can see when the actual announcement of reciprocal tariffs happened and how everything declined in a very short period of time. It subsequently rebounded as we got a better handle on what these tariff announcements actually meant versus the initial shock of the announcements. And, we move through that period of time to end the year. I've got a black line denoting the end of the year with everything up. Small and mid cap stocks lagging large caps, but international stocks clearly performing better than US based stocks. And this is, to remind you, this is put from in context of a US investor. So if you're a U.S. investor and you own foreign stocks, you essentially own foreign currencies, and the dollar has gotten weaker over 2025. So when you translate those holdings back into U.S. currency, you have more dollars. So that does help your return. It's not the only reason that the return is the way it is, but it certainly does help the return from a U.S. investor's perspective. Okay, the asset quilt is just looking at, so the way to read this is every column starting with 2011, so the last 15 years, every column is a year, and then it's just ranking the highest return by asset class. So you can see, for example, 2025, the rightmost column, emerging markets and developed markets. Those are international stocks. Those performed the best, followed by large caps. So kind of mirroring the index I just showed you on the previous slide. And then, there's commodities in there, which is kind of a basket of commodities. There's precious metals, but then there's also things like oil and agricultural commodities in there, performing well, primarily due to precious metals, which I'll show you a slide on that in just a minute. But really everything positive for 2025. One thing to note is that earnings grew in 2025. So this chart is showing you the S&P 500 earnings. The blue line is actual earnings. So you can see it over time trending up, dipping as we hit the COVID shutdown, but then growing and continuing to grow. And it grew through 2025. So the overall earnings for the S&P 500 grew in 2025. This shows you expectations, not actual results, for 2026 and then beyond. I'm not really concerned so much about expectations, long term, because those can be very difficult to actually get right. But the expectations for 2026 for the S&P 500 are earnings growth between 13 to 14%. So companies are still growing their earnings. What I would note is that in the past, the primary driver of earnings growth has been those Magnificent Seven companies, those big tech companies. One way to think of them as kind of the manufacturers of AI, which has been a very popular theme over the last couple of years. But what we might be seeing is a bit more broadening out of performance among the S&P 500, the other 493 stocks, because they are the users of AI. So can they theoretically make use of AI to make the companies more productive, control their costs, grow their revenues, and improve their earnings? And continuing on with this earnings theme, mid-caps are expected to grow their earnings as well. And I want to focus more on this red line. That's short-term earnings growth. And what they mean by short-term here is the next 12 months. So you can see those earnings expectations as you go to the far right really starting to jump. We're seeing an increase in the expected growth rate of mid-cap stocks. This is important because mid caps have kind of underperformed large caps for a couple of years. And the same principle kind of is showing through on small cap stocks, which are showing kind of an increasing trend in that red line in short-term earnings growth expectations. So the reason I want to point this out is how expensive are these different categories of stocks? So, and what is a measure of how expensive different categories are? When we talk about how expensive things are, we typically will talk about price to earnings. And a way to think of that is a PE is just a number. So if it's 20, that means you're willing to spend $20 to get $1 of earnings over the next 12 months. Okay, so now, what are the PE ratios for different categories of stocks? And in this case, the pink line is the Magnificent Seven. That's their forward PE. It's right now kind of close to 28. So $28 for next year, $1 of next year's earnings. Whereas the S&P 500 as a group, which includes the other 493 stocks, is around 22. And then mid and small cap are lower by multiple turns than that. So they're cheaper, mid and small cap stocks, they're cheaper, and they tend to historically be a bit more volatile than large caps, but they're cheaper and they're starting to show improved earnings growth outlook. So we got a question in advance that was, how do I avoid the Magnificent Seven? Because if you invest in the S&P 500 index, you are going to get Magnificent Seven exposure there. It's more than 30% of the index. There are a couple of different ways. One of them might be to look at mid and small caps and make sure, don't replace your large cap holdings in their entirety, but make sure that you have exposure to mid and small cap stocks in your portfolio. Kind of going back to this theme of resilience, one way to maintain resilience is to maintain diversification in your portfolio. There's a different way as well, and that is growth versus value. Growth stocks tend to be those companies more tech-oriented that have higher expected earnings growth rates, but they also tend to be more expensive. Value stocks are more of your steady Eddie type of businesses. This could be, like a Coca-Cola or a consumer staples type of business that's just maybe doesn't grow as fast year in and year out, but is cheaper. So again, we're looking at PE, so how expensive are these different categories, one versus the other. And the S&P 500 growth category is more expensive than value. Now, we would normally expect growth to be more expensive than value. That's kind of a feature of growth stocks versus value stocks, if you will. But the gap between those two changes over time, and you can see that it's gotten quite large, which means that growth stocks are more expensive than they normally are versus value stocks. So again, if one were looking to avoid the Magnificent Seven, perhaps one should look at an ETF that replicates a value style index, like an S&P 500 value index or a Russell 1000 value index. You can also look for active managers, if that's what you want to do, that are more value oriented. So that would pick up more on the blue category of stocks than the red category of stocks. So I did mention precious metals. I want to show you how they've done. They've done extraordinarily well in 2025. So we're looking at gold spot prices in blue and silver spot prices in red. By the way, the vertical axis here is not a normal one. These numbers are not spread evenly. They're designed to show you, it's a logarithmic scale, so it's designed to show you when something's doubled. So, for example, you can see that, over the last year and change, gold has doubled in price. So in a very short period of time, gold has doubled. And we've seen silver has done has the same trend. It's gone from 40 to 80 in a very, very short period of time. Now, the reason this is important, sometimes investors will view having some precious metal exposure as a good way to hedge against global risk, and certainly that's been kind of the trend right now with all of the noise coming out of the administration and the looming threat or the removal of the threat of trade wars, and other type of news like Venezuela or Iran. That's led to a trend of a strong uptrend in silver and gold over the last year or 18 months. I do want to caution that in both of these cases, they've moved very quickly in a very short period of time. Does this mean that they have to sell off? Not necessarily. There tends to be some momentum sometimes in commodity prices. There's momentum until there's not. It's really hard to determine an inflection point, but we have seen, precious metals move up in a very short period of time and then trend back down. So just to make sure that you maintain, if you do have precious metals in your portfolio, it's as a hedge, which means it should be a smaller allocation to your portfolio, and also be mindful of the fact that it has moved quite a bit in a very short period of time. And then the dollar itself, I mentioned that it had weakened in 2025. You can kind of see that in the most recent dip in 2025 towards the right. It's kind of bounced off what, this is technical charting, but kind of a support level. It appears to have kind of found a bottom. Does that mean it's going to trend up? That's really hard to tell. I would say no one really can forecast currency with any strong ability, but it has sold off quite a bit and seems to have reached some sort of support level. So where it goes from here really depends on things like the specter of trade wars, and if tariffs get removed, that could theoretically help the dollar quite a bit. I do want to shift gears and talk a little bit about bond yields. So this is looking at what kind of yield you get on different parts of the bond market. So the blue line, the 2-year Treasury yield, it's close to 3.5%. The red line, that's the 10-year Treasury, a little bit north of 4%. And then the 30-year mortgage rate, just so you can kind of get a sense for that, is a little bit above 6%. So what you see is that your yield goes up if you go longer in maturity. Why? Because you are taking what we call interest rate risk. That is kind of the risk that what you're receiving right now may or may not compensate you well enough as interest rates fluctuate over the period of time in which you're holding that bond. But then we also have in kind of the dark purple high yield corporate bonds. So these are what we would call junk bonds, and they offer something a little bit higher than the other categories. And there it's not so much about maturity, but it's about credit risk. Will you get paid back? So in order to compensate you for taking on more credit risk, investors expect to get paid a higher yield on those. You can see since 2024, generally speaking, the rates have trended down. But in the case of the 10-year, if we look at it over the past few years, you can see it's moved quite a bit. The 10-year Treasury is definitely impacted by news. And so you can see, for example, in April of 2025, Liberation Day announcement, Liberation Day postponed. You can see there's quite a big move in the 10-year Treasury at that point. We appear at this point to have come to a bit of more of a stabilization in the 10-year Treasury. But again, going back to the cartoon, stay alert. Things can change, and if the more the market senses risk, the more that 10-year Treasury can move up. And when it's more comfortable, the 10-year Treasury can kind of stabilize or move down a bit. I do want to close talking about interest rates by just mentioning again mortgage rates and home sales, because I think for a lot of people they want to get a sense for how the housing market is doing. So the mortgage rate, the average 30-year mortgage rate is in dark blue, and you can see over the last couple of years it's started to trend down. It was very, very high in the beginning of 2023. It's finally started to really trend down, and that has helped home sales, which kind of fell off a cliff, as these mortgage rates really went up and spiked in 2023. You can see that they're finally back to, a positive change year over year. So the housing market, if rates can, I don't know if they can come down a whole lot more. The 30-year mortgage rate is really tied to that 10-year Treasury, so it really would require the 10-year Treasury to kind of come off a bit more. But it's certainly, the mortgage rate has stabilized a bit and is leading to a return to positive single-family home sales. So that's good for any of those who are, interested in buying or selling a house now. So with that, I'm going to turn it over to Stephanie, who has a lot of good information to relay to you on financial planning in 2026.
Fantastic. Thanks, Greg. And thanks to all who've joined us for this beginning of year financial planning guide. Turning to the next slide, we see that after a chaotic start to the year, with changes in the political landscape, the arrival of Doge, as Greg mentioned, a historic increase in tariffs, and then a stock market sell-off in the face of Liberation Day and the tariffs. We move along to the next slide and see that, as we've talked about at length, stock markets performed well in 2025. U.S. markets were strong. International markets were particularly strong. And I don't think that there was necessarily a slowdown in activity during the year. This graphic sort of presents things in a very orderly fashion. I think that after the initial shock of the first few months of 2025, we either became numb or we just kind of began to be able to process all that was going on. In the second half of the year, you'll recall on July 4th, the One Big Beautiful Bill Act was signed. We'll touch on some important considerations there. If you are a pop culture watcher, Taylor Swift and Travis Kelce finally announced their engagement. There was a daring daytime break-in at the Louvre in Paris, and then we were all stunned to see the longest government shutdown in U.S. history. Nonetheless, we had a strong finish for markets for 2025. If we take a look at the next slide, as we embark on 2026, it's sort of a new year, but kind of the same resolutions, right? Money or finances remain in the top 3 or 5 resolutions amongst people who make at least one New Year's Eve resolution. And that's true across a variety of different age bands. If we take a look then at the next slide, for those, against this backdrop, political and economic backdrop in 2026, the top concerns that are cited from U.S.-based investors is rising everyday prices, unexpected expenses or financial surprises, and then rising healthcare or insurance costs. And this, again, is sort of across the age spectrum. Taking a look at the next slide, once people come up with the resolutions, they then need to sort of fill in with some specific goals. And it's interesting looking at the chart on the left, regardless of the age, Gen Z, Millennial, Gen X, or Baby Boomers, vacation or travel was the top goal for which people were saving money in 2026, followed by a down payment on a car, particularly relevant for Gen Z and Millennials. And then looking at the Gen X and Baby Boomers, home renovations or improvements were top goals. But interesting, this sort of focus on vacation or travel is a top goal for 2026. Only about 40% of Americans felt confident that they were going to reach their goals, which means that 60%, a majority of folks, were not confident that they were going to reach their financial goals or resolutions. Why? Their top concerns were rising costs and difficulty maintaining habits, really a behavioral sort of issue, which to greater or lesser degrees is within one's control. So focus on shorter term travel and some, again, continuing concerns on rising costs. This issue of habits, I think, is something we want to focus on and keep top of mind. Taking a look then at the next slide, you see, for those who've joined us before, our familiar four-step beginning of year review process. Given the year that we just experienced, right now that 2025 is behind us, I think in this instance, I might be inclined to start this review process at step 2, which is to assess your current situation, especially relative to the prior year. Portfolios have increased significantly. We've had changes in tax policy. There were some changes to the limits for estate planning exemptions, etc. So you might just start, where are you right now? And then go backward one step to revisit or to establish your goals. Then continuing on with the process, step 3, to identify areas of improvement or opportunity. And lastly, to chart some courses or routes to achieve whatever goals you've specified. This is an ongoing process, so once you've gone through this, you monitor and repeat as needed. Taking a look at the next slide, we've outlined, our load-bearing pillars for your financial blueprint. Trying to manage your money or your finances without a plan is a bit like trying to build a house without a set of blueprints. So these we've laid out here, the 5 load-bearing pillars of your financial plan: cash flow, taxes, investments, estate planning, and insurance or risk management. We'll get into each of these in a little bit more detail momentarily. The key thing to keep in mind when you're evaluating these 5 pillars is, do any of these areas need urgent attention? What might that be? For example, if you don't have a will or any kind of financial or healthcare POAs, that might bump to the top of your priority list. If you have small children and you don't have any life insurance, for example, or you have no will or guardianship provisions, that might bump estate planning to the top of your list. Also, it's important to consider, are any of these areas not even on your radar screen? Important to focus on. You want to make sure that nothing is being forgotten, nothing is left outside of consideration. All of these areas, we're going to be focusing on a financial component, but taking a look at the next slide, I think it's important to consider that it's not just about the money. In this survey that Schwab did last year, they asked participants, which of the following factors contribute most to your personal definition of wealth? And edging out money slightly was happiness. And amount of money came in second, followed by physical health and mental health, and bringing up the rear quality of relationships and life experiences. So it's really important to consider that you need to think about, how does the money that you've worked so hard to save help you to achieve your financial or your life goals? What experiences does the money allow you to have? The other question or other way you might come at it is, what is it that you really want to do that you haven't been doing, and why? And what's the price tag associated with that, and planning for that? As we think about the pillars and as we think about this, how do you define wealth question, I think it's important to focus on building in resiliency to your plan, thinking about the things that could cause your plan to go off the rails, building in flexibility, and making sure that you're landing on your feet and able to continue on regardless of the market circumstances or environment. This sort of resiliency in the plan, the dynamism in the plan, will help you to move forward to your ultimate goals, and also help you to stay on track even in the face of detours or uncertainty. Taking a look then at the next slide, this is our planning template. It's blank. We'll fill it in over our remaining time together. Here I've added, in addition to the 5 pillars that you see running from left to right on the top, we've added in stages of your career: early career, mid or late career, and then retirement. Taking a look then at the next slide, let's just jump right into this with cash flow. Here, the focus is taking a look at what's coming in and what's going out in terms of income coming in and expenses going out. This is an important factor regardless of where you are in in your career. It's particularly important if you are starting out, right, with your first job, to get a handle on your spending relative to your income. But it's equally important in those later stages of retirement. We all hear the adage of go, go, slow go, and no go in retirement stages. So it's important to keep in mind that spending plan, what I'm calling the spending plan, what's coming in and what's going out, is dynamic and it changes throughout life. So we want to keep track of it so that we can plan accordingly. The next thing to keep in mind with regard to cash flow is to manage both sides of your balance sheet. People oftentimes are very much focused on the investment piece of things, but there's also the liability side of your balance sheet. What liabilities do you have? You know, when you're starting out in career, probably the primary liability would be student loans. Mid-career, you probably have a mortgage. Maybe you're paying for education for kids. If you're in the sandwich generation, you might also be footing some expenses for aging parents. And then in retirement, hopefully the debt has been retired before you embark on retirement, but increasingly we're seeing people going into retirement with some degree of debt. So again, managing both sides of that balance sheet throughout the various stages of career. This I just mentioned, I think I'm preaching to the choir here. Early and ongoing retirement planning. Starting out when you're in your 20s and saving for retirement allows you to benefit handsomely from the power of compounding. It's very difficult, as we all know, to plan adequately for retirement if we only start 2 or 3 or 5 years prior to the targeted retirement date. But again, this is a focus throughout the various phases of life as to where you are and what strategies are necessary to sort of catch up and get you back on track. And the last thing I'll highlight on this page is liquidity management. How much cash do you have? Let's turn to the next slide for a bit of a focus here. Cash is a question that oftentimes comes up in conversations with clients. How much cash should I have on hand? Well, the short answer is it depends. It depends on what your spending is. It depends on what stage of life you happen to be in. If you take an early career person, someone who's just out of school, they probably need at minimum 3 to 6 months worth of living expenses to cover an unexpected breakdown of a car, a move, or a loss of a job. Minimum of 3 to 6 months. Obviously more would give you a larger cushion. For folks in the mid to late career phase, 1 to 2 years worth of living expenses is probably adequate. Again, if your expenses are a lot higher, you may want to scale up accordingly. Also, if you have a very high income or if there's variability in your income, you may want to adjust your cash or liquidity targets upward. In retirement, I like to think about this in a kind of a multi-layered way. At a minimum, you probably want to consider having 1 to 3 years worth of living expenses after you've taken account for Social Security or any pension or other sort of fixed or guaranteed sources of income. That's sort of your basic first line of defense in the face of a market downturn, that you will be able to continue your standard of living without interruption. The next layer for retirees would be another potentially 1 to 3 years worth of living expenses in short-term investments that are probably going to give you a little bit more yield. This first layer is probably in money markets or CDs. You might invest that second 1 to 3 years worth of living expenses in short to intermediate term fixed income. You might do laddered CDs or laddered short-term treasuries. This, again, safe and liquid, but a second line of defense so that you're not liquidating holdings in the face of an equity market downturn. So that's something that you can sort of evaluate. Where are you in terms of your liquidity management, and are there some areas for improvement there? Moving along then to tax planning. As you know, the One Big Beautiful Bill Act was signed on July 4th. Many of the changes from the Tax Cut and Job Act back in 2017 were made permanent. There were also some new changes introduced as well. We'll highlight just a couple of them. The focus for tax planning is really to look for opportunities to optimize your lifetime tax picture. What does that mean? Really to try to minimize your overall lifetime tax bill. Sometimes folks get very caught up on minimizing taxes in individual years. That's important, but really you want to try to focus on the remaining time that you're here on this planet paying taxes. That usually comes in the form of, maximizing your pre-tax retirement contributions, catch-up contributions for those over the age of 50, and then there are special provisions for folks in the 60 to 63 age band, those catch-up contributions, HSA or FSA contributions, to try to bring down your taxable income. A variation on that theme would be for people over the age of 70 and a half, QCDs, right? Instead of taking that required minimum distribution, you can just transfer it directly to a charity and you would not recognize that amount as taxable income. So there's focusing on your minimizing your taxable income. There's also a focus on looking at what deductions you might take, right? With the changes in the tax law, the standard deduction is now higher on a permanent basis, $16,100 in 2026 for a single filer, $32,200 for married filing jointly. So you want to give some thought to, are you going to itemize this year or are you going to take the standard deduction? We'll delve into an example more on that in just a second. The other piece that you want to take into consideration with regard to taxes is managing your tax brackets. You should know what tax bracket are you in, how much room do you have before you get you're bumped up into the next tax bracket, and that will again help you to consider the timing of recognition of income. And this piece sometimes gets lost in the shuffle, but asset location is also important. Why are we talking about this? The focus here is to try to put assets in the most appropriate categories in order to maximize your after-tax return. Let's take a look at the next slide and come back to this issue of should I itemize or should I take the standard deduction. Here we have a stylized example. This is a donor with income of $750,000 in the 35% tax bracket, married filing jointly, and they typically itemize. You can see at the bottom in the highlight box, they are taking the state and local tax deduction, which you'll recall is bumped up to a max of $40,000 for most folks, except for the very highest income brackets. That is a higher level is applicable from 25 to 2029. In this example, these folks have state and local tax deductions of $15,000. They also have mortgage interest of $10,000, and they typically contribute $20,000 per year to charity. I won't go through this in detail, but I just want to highlight a couple of things. If this couple were to just contribute their $20,000 each year in 26, 27, and 28, they are subject to a floor on charitable contributions, which is new for this year. So their SALT and mortgage interest deductions total $25,000, that top line of other deductions. You see their charitable donation of $20,000. Their floor, which is zero, which was introduced with the Big Beautiful Bill, the floor for charitable contributions is now 0.5% of your AGI. So in this case, if you multiply that by their income, you get $3,750. So in this case, their itemized deductions are $9,050 over the standard deduction. This would yield at their tax bracket a potential tax savings for them of just over $3,100, $3,167 estimated. Multiply that times 3, in this case we're just looking at a stylized 3 years, and they have potential savings of $9,502 over a 3-year time span. If we instead skip over to that column on the very far right, if they instead combined 3 years worth of contributions, charitable contributions, into 1 year and made a donation of $60,000, their itemized deductions would increase, of course, to $85,000. They still have that same $3,750 floor. Now they have itemized deductions that are just over $49,000 higher than the standard deduction, yielding a potential tax savings of about just over $17,000. So this is an example of you want to think and evaluate each year. Even though we have much higher standard deductions in place, it's still worthwhile to evaluate and plan proactively to be strategic about whether you want to itemize or take the standard deduction. Would you engage in some bunching strategies in order, again, to reduce your overall lifetime tax bill? Moving then to the next slide, we have this question of investment planning. Okay, Greg talks a lot about the market and economic environment. Here, we just want to focus on a couple of things with regard to your investments. First and foremost is to have an investment policy, a written investment policy. This is going to change over time. Your investment policy at 25 will likely be quite different from your investment policy at 75. But the focus is to have an understanding of what your ability is to tolerate risk, to optimize your investment portfolio's risk and return profile, meaning to take a level of risk that you're comfortable with, that you can sleep well at night, and to make sure that you're compensated for any risk that you're taking in your portfolio. As Greg touched on, you want to make sure that you are diversified across asset classes, stocks, bonds, cash, alternatives, etc., real estate, and also within asset classes, large, small, U.S., non-U.S. The other piece, and which we touched on a moment ago, is to diversify across types of accounts. Three main types of accounts are really relevant here: your taxable brokerage account, your tax-deferred retirement accounts, whether that's 401k, 403b, IRA, TSP, and then your tax-free Roth accounts. Having these three buckets really allows you the most degrees of freedom in terms of strategizing about, in particular, a retirement income strategy. It's very difficult to strategize when you have only one of these buckets filled. For example, if someone were to come to us with just a 401k bucket or an IRA bucket, it's a bit like playing a one-note or a one-string guitar, right? There's not a lot of strategizing that we could do relative to someone who had all three of these buckets populated. Taking a look at the next slide, we have just some general rules of thumb or guidelines in terms of the most efficient places to locate assets. For example, municipal bonds are tax-free, so you probably don't want to put them in your retirement account. Most efficient to put them in a taxable brokerage account. Stocks, for example, or stock mutual funds that have a very high turnover rate, which means that they would be taxed at ordinary income tax rates, you probably want to put those in a tax-deferred account, along with your fixed income, which would be typically taxed at ordinary income tax rates. More efficient, generally speaking, to have that in a tax-deferred account. Your individual stocks, stock ETFs, which you're holding for a long time period and which would be taxed at long-term capital gains tax rates, you want to have in those taxable brokerage accounts. They benefit that you're not paying taxes until you actually liquidate, and when you pass on, your heirs would benefit from a step up in basis for those long-held assets. So that's another action item or area of focus to take a look. Do you have appropriate diversification across all of these different account types? In addition to diversification across the asset classes, and within asset classes, diversification across account types, and have you really given thought in conjunction with your advisor on the most appropriate location for the various assets in your portfolio? Moving along then to another account, which we won't touch on this because this could be another topic in and of itself, but Trump accounts. I won't go through this slide in detail, but I'll highlight that you might want to consider a Trump account if you have a child or grandchild born between 25 and 2028 who has a Social Security card. This is a Social Security number. This is basically free seed money that could be used for planning for long-term retirement. Is this going to replace or supplant a 529 plan for education? No. But I think taking a look at the next slide, these can be used in a complementary fashion, right? You can use your 529 for qualified education expenses, and also with the expansion and changes in rules previously, you can also use the 529 for K through 12 costs. The Trump account doesn't have the same degree of flexibility, but nonetheless, $1,000 of seed money growing over time could wind up being, significant dollars by the time this child retires. So just something to keep in mind. We'll probably have a blog post or some other post on this topic later on, but just keep in mind that this is another tool in your tool bag, and it is free seed money from the government. Moving on then to estate planning. Here, I'll just highlight a couple of things. Make sure that you have basic estate planning documents, which would be a will, a trust if it's applicable and relevant for your situation, and a financial POA and a healthcare POA, so that someone is designated to make decisions on your behalf if you're incapacitated. Documents should be updated probably every 3 to 5 years in order to be most relevant. You probably want to do a scan or a check at least once a year to make sure that your beneficiary designations are up to date. You want to give some thought to planning for estate taxes, right? The limit or exemption level for 2026 is at 15 million lifetime exemption for estate taxes. A lot of folks say, well, I don't have that much. This is not really relevant. Taking a look at the next slide, for folks who are in the DC, Maryland, and Virginia area, it's really important that you don't forget about estate taxes at the state level. In DC, we're just shy of 5 million. In Maryland, the level exemption level for folks who are passing on in 2026 is 5 million. Plus, there's an inheritance tax for non-exempt beneficiaries. And then in Virginia, no estate tax, no inheritance tax. So you just want to do a quick scan here to make sure that you've covered your bases. Maybe you need to chat with your estate planning attorney about some steps to take to minimize your state estate taxes as well. Moving on then to insurance planning. Here, the focus is looking at events that could derail your financial plan. And the key question is, do you want to assume the risk yourself, self-fund, in other words, or do you want to offload some or all of that risk to an insurance company? And it's important to reassess your risk levels as your life changes, right? When you're 25, early career, most of your insurance is probably going to be covered through work. As you get mid to late career, you might want to consider some kind of a long-term care plan. If you have teenagers driving your cars, you might want a personal umbrella liability plan. You might need some other supplemental policies, individual policies that would be separate from work. And then in retirement, of course, you have special considerations around Medicare and Medigap for your health insurance, and formulating some sort of a detailed long-term care plan becomes even more important as we get older. Taking a look at the next slide, this is just some quick sort of format or framework for each one of you to evaluate where you are on these things. Health, life, disability, property and casualty, probably not an issue. The last two, additional liability or an umbrella policy, something you may want to consider, particularly relevant if you were ever sued or a judgment were awarded against you because you had caused an accident or someone was injured on your property. Doesn't cost a lot for a couple $1 million worth of policy, and if you need it, you find that you really need it and you're glad that you have it. The last piece is long-term care. I'm not licensed to sell insurance, so I don't have a dog in this fight, but I'd be derelict in my duties if I didn't discuss with clients and prospects the need to have a long-term care plan. In this area, DC, Maryland, and Virginia is very expensive for assisted living, $10,000 to $15,000 for if you're just needing minimal aid. For cognitive care, it could easily be north of $20,000 per month. So the action item here is to make sure that you understand what's covered and what's not under your policy, that you keep an updated video inventory of your valuables in particular, that you have some kind of a backup plan for your important documents, either cloud-based or a hard drive, and that this is another thing to make sure that you've taken some precautions around data privacy and cybersecurity. So this is another checklist item to make sure that all of your bases are covered. These really are looking at things that could derail the plan and that have big ticket price tags associated with them. That brings us back to our next slide, our template, which is now all filled in, right? In order to build in resiliency in your planning, you have to factor in all of these 5 pillars. You have to think about where you are relative to the action items that we discussed: liquidity management, minimizing your lifetime tax bill, making sure that you have appropriate diversification and location of assets, making sure that your bases are covered in terms of estate planning, and again, really thinking quite carefully and broadly about the types of risks that could derail your financial plan. And with that, we have raced through a lot of ground. If you have any questions, please feel free to contact Greg or me after the fact, and we'll make sure that those questions get answered. Greg, I'll turn things back to you.
Okay, well, Stephanie, thank you very much. I do think we could probably, I know we're at time. I would like to maybe just get one question in, since it was essentially about, someone who's a new homeowner, and really, Stephanie, a question for you, which was, as a first-time home buyer, what are good savings goals to have in case of emergencies to the house? And are there any other financial planning considerations I should have now that I own property?
Well, a couple of considerations, right? You want to consider, is it a new home which is under warranty, or is it an older home, in which case you might be on the hook for a whole host of different repairs. Could be HVAC, could be roof, could be any number of plumbing or electrical. So that would be my first question: new home or existing home? You've likely had a home inspection, and your inspector probably highlighted a couple of things. That would be your sort of guiding light in terms of what areas might be problematic, and then get some estimates for the price tag for those things, right? HVAC systems can vary wildly in terms of the expense. If that's an issue or consideration, you may want to plan for that. Typically, people have drawn down significantly on their cash reserves after they've gone to settlement. So if you're thinking proactively before you go to settlement, you'd want to try to maybe have a bit bigger cushion left over to make sure that you're covered for any kinds of things that could go wrong after settlement. I think about a client that I had a number of years ago who went to settlement on a condo in DC. She kind of stretched to buy a slightly more expensive condo. As soon as she got in there, there was a $50,000 special assessment that had to be paid. You either stroke a check or you finance it, right? And so fortunately, she had very gracious and generous parents who floated her the $50,000. But that could be a problem, right, if you are on the hook for such a sum after you've already gone to settlement. So think about sort of the age and type of the home, and what kinds of things could go wrong, and then set aside some savings accordingly.
I'm just going to handle one last question we got right at the end here about Annaly Capital Management, which is ticker symbol NLY. It's a REIT. It's a mortgage REIT, essentially. So they invest in mortgage-backed securities, government guaranteed mortgage securities. Yeah, certainly that's something that's going to offer a high yield. It can be appropriate as a part of a portfolio, just to understand that as mortgage rates come down, or as things get potentially, there's some risk of prepayment as rates come down with refinancing for things that are at particularly high mortgage interest rates. That that rate, that yield that it has could decline over time. So, again, something that could be considered part of a portfolio. All right, and with that, we want to thank you very much for joining us, and we hope you have a great rest of your day. Take care, everyone.